Good evening, everyone, and I apologize for the delay. For some reason, our audio drivers on this PC just died, and we had to do a quick fix. So we're about 10 minutes late, and so I apologize. I know we lost one viewer. I did say we'd be delayed, but we're going now. Well, good evening, and welcome to the FOMC edition of Bond Squad After Hours. As always, Bond Squad After Hours is brought to you by Wealth Strategies and Management / Bond Squad. The Bond Squad and Wealth Strategies and Management are separate entities from Private Advisor Group, which is our registered investment advisor. Well, good evening, everyone. We had our much anticipated FOMC meeting, and it seems to have left some people, some market participants, less than enthused or less than overwhelmed or underwhelmed, as the case may be. We weren't very surprised here at Bond Squad. I mean, basically, Ms. Yellen made it clear that the economic conditions in the Fed's estimation were not conducive to a rate hike at this point. Now, interestingly, the Fed sees conditions improving, but lowered its growth forecast for 2015 to the 1.8 to 2% range, or as some people say, 1.9. And next year, it thinks the economy accelerates to the 2.4 to 2.7 range. All right, better, and better than like the 2.2 average we've had in this recovery or this expansion. You can't call it a recovery anymore. It's recovered, and that's our point as we roll along here. We think that this is the economy, and that's not troubling, but it's something we have to consider. If these conditions are not sufficiently good, sufficiently strong for the Fed to raise rates, tighten policy, will the Fed raise rates and tighten policy? We think the Fed will. We're still looking at a September liftoff for tightening. But what's interesting, and by the way, we put a 50% on that, 25% for December, and 25% for the first quarter of next year. If we were, a gun was put to our head and we had to do it. We were supposed to do this broadcast, by the way, from our boat, but the weather looks a little ominous, so we stayed on shore. Readers did not need to see our rendition of the wreck of the Hesperus with my wife tied to a mast or something. But the question is, will the economy be strong enough by September for the Fed to tighten? We think at that point, the Fed is going to say, you know what? It probably isn't going to accelerate. The economy is not going to accelerate any better than it has been. Let's go ahead and do a quarter point tightening. And, that's probably it. And it might not even be a full quarter. It just might say, the new band, as it were, is instead of 0 to a quarter, it's a quarter to a half. You might get a Fed funds rate at a quarter, at 30 basis points, 35 basis points, somewhere between that quarter and a half band. That's what we think happens here at Bond Squad. Ms. Yellen pointed out that it's not when the Fed lifts off, but the pace of rate increases is what the markets should be focused on. And we agree with that. We agree that the primary focus should be the pace of rate hikes. And if you listen to the Fed, the pace is going to be pretty slow. That's what they expect. And that's if the economy improves according to the dots, which is a little bit better than what the fixed income market thinks it's going to be. So the Fed forecast for the Fed funds rate by the end of this year is 5/8 of a point. The street is about 31 basis points. The end of 2016, the Fed thinks the Fed funds rate is around 1 5/8. Street thinks about 110 to 115. Bond Squad thinks about 1. And in 2 years, the Fed thinks that it's going to get to some sort of neutral rate or peak rate, depending who you speak with at the Fed, of around 2 7/8. And that speaks to what we've been writing for several years, that the peak Fed funds rate is going to be lower, probably going to be lower than it has been in the past. And Ms. Yellen said that today. Says the Fed funds rate and interest rates in general will probably be lower than normal. What they consider normal. The question is it really below normal, or is it the new normal? And we tend to think it's more like the new normal. To plagiarize a little bit Muhammad El-Arian, we think it's kind of the new normal. And by the new normal, we think that inflation will be probably subdued enough to where the Fed doesn't have to raise rates very high to do it. The Fed also spoke to unwinding the balance sheet and has no plans on doing so in the near future. Now, last week or the week before, New York Fed President Dudley said that the Fed would probably tighten or begin tightening before it considered shrinking the balance sheet. Sorry, we're on vacation and I'm still having some computer issues here, and I apologize. It's not cooperating very well, but we think that the Fed doesn't do anything to shrink its balance sheet, and we're not sure if the economy picks up past this pace of growth. Now, that presents a problem for those who are banking on higher rates. And we heard it again on television today. Well, if the Fed funds rate is 2 7/8, doesn't that mean that the 10 year is 4 or 5%? No. It's true that the spread between twos and tens on the Treasury has been about 145 basis points on average. But the curve is steepened as it is now. We've seen it steepen to 300 basis points. And we also see the curve flatten and even invert, right? You see, just because the Fed funds rate is at 2 7/8 doesn't mean that the 10-year note rate is at 4 or 5 or even 3. It could be 2.5, have an inverted curve if you have a recession or a severe economic slowdown happening at that time. So what we believe is that much of the long-term rate rise that we are going to see in this cycle, unless we see a big pickup in economic growth, a big pickup in inflation, and that's going to take global growth to pick up too. We can't generate inflation and growth on our own, really, and it's tough to generate inflation when your currency is the strongest around, right, or has the most demand. So it's not like people are going to abandon the dollar and it devalues. So, maybe at some point we see 3% on the 10-year, maybe we don't in the near future, and that's something that has to be considered. Same with inflation. Why do we think inflation is gonna soar? The Fed is saying that it doesn't think its measure of inflation, core PCE, gets to 3% even through 2016. I mean 2% rather. Sorry, I apologize for that. Up to 2% through 2016. It might not get there through 2017 to 2018 for all we know. There's nothing that says that it has to do that. So the Fed doesn't have to raise the Fed funds rate very much to get to that point. So we think that we're kind of stuck where we are as far as long-term rates. We think most of the rate increase will be on the short end of the curve. How do you play that? Well, you barbell your ladder. You let your long end of your portfolio generate the returns, the solid, steady income, and you use the short end of your portfolio to reinvest if and when rates go higher. If rates don't trend much higher, the Fed keeps rates lower longer. At least the long end is going to help you. People go through all these machinations about how to play interest rates, how to protect one's portfolio from interest rates. Something as simple as a ladder or a barbell can do a pretty good job for most people. It's not a real difficult concept to grasp. It could really be just that simple. And I apologize. There's something I wanted to bring up here, and I cannot get this computer to respond to anything at this point. It just won't respond. As something has really gotten into here. I wanted to go over a quick report that we put out in the morning, and give everybody a little preview of the bullet points. But basically, what we're seeing is that the Fed is not in a hurry to raise rates. It might not see what it needs in September. We think it will go anyway just to say that it did something. There could be downward pressure on long-term rates. We think the general trend is curve flattening. What else do we have here on our notes here? Since our computer, we're back on notes now. I did this just in case we ever had a problem here. Let's see. Fed sees 2.4 to 2.7 growth. Wants to be reasonably confident on inflation. So in other words, the Fed might not need to see inflation at 2 before tightening, but it probably wants to see some upward pressure. Maybe it wants to see a few prints of core CPI, not headline, because oil can force the headline number to be artificially low or inordinately low or inordinately high if it's going the other direction. So I want to see core inflation, probably at least a few prints above 1.5 before it wants to print. It probably wants to see wage growth get above 2.5, closer to 3. It probably wants to see the unemployment rate sink to about 5, while simultaneously labor force participation increases. If it goes to 5 because people are just dropping in the labor market again, that's not the same. And this is where the models get into trouble. People who want the Fed to be completely data dependent as far as whatever the data says without taking the context, that really gets you into trouble, because you have to know for what reason inflation's where it is, unemployment's where it is, and wage growth is where it is. You can't just simply say, "Oh, it's here, so we got to do it." That's very unsophisticated and a bit childish, if you ask us. It really is, but that's how we see things going forward. And I apologize for being choppy here. This computer, it was working fine all day, and decides now, of course, that it's going to have some conniptions here. There's something I did want to cover and read. Just bear with me, and I do apologize for this. But technology isn't perfect. This is why we don't totally rely on models. If the computer has a hiccup, then what do? We have to use our brains and go with it, which we're trying to do. Use our brains, here at Bond Squad, to try to navigate this. And I just wanted to read something here. And heard that thing, that little ding, that little bell that tells me the computer doesn't want me to read it. So, at least we're consistent here in computer land. If you hear about a man beating a computer tonight in Pennsylvania, you know who it is. I wonder if you can get arrested for that. What do we get here? So, the Fed also said that while it's concerned about exogenous events, overseas events, it is focused mainly on the U.S. What's necessary for U.S. economic growth, sustained U.S. economic growth. Oh, look, the computer's responding now. It's about time, since we're almost done here. But so this presents a problem potentially for foreign fixed income, especially emerging markets fixed income, because if our rates do trend higher, even if it's just the short end rates, it's going to pull short end rates, or if our long-term rates move long-term rates in emerging market economies. This makes their financing costs high for both businesses and for consumers. Now you could say, well, Brazil is double digits, well inside 10 years. Yeah, but what if he goes up another 300 basis points? It's that would really put a damper on things in Brazil, right? So our rates make life difficult. Our rising rates make life difficult for foreign investors, for foreign businesses, for foreign governments. It is not what they'd want to see unless the economy is in fact stronger. Let's see, we get this here. Hold on, it's kind of working here, guys. And let's paste that link in, copy. This is actually rather embarrassing, but nothing I can do about it here. Copy, tab, paste. Give everybody a sneak preview here. And we lost one of our readers before, our viewers before. I don't blame them. This is like watching paint dry. So basically, the Fed has lowered or slowed its pace of tightening forecast. It's lowered growth forecast. It's lowered its inflation forecast. If you listen to Ms. Yellen's tone today, she seems to be resigned to the fact that this might be it as far as what the Fed can do at this point to juice the economy. So this is probably our growth. What we would be doing here is pulling back on our credit risk. We're starting to see corporate defaults reach their highest levels since 2009. We don't think that this is over. Revenues for these junk rated companies have not increased as expected. Some of them not at all. Even a modest rate increase could cause a risk-off mentality, spreads to widen. So we might see the Fed raise the Fed funds rate 50 basis points in the next year, or 75 basis points the next year. The 10-year note basically does nothing, and credit spreads on triple C bonds blow out 200 basis points. They get a 200 basis point, a 2 full point increase in the financing cost on a risk-off situation. So we're not sanguine on that area of the fixed income markets. Where are we here? It's working now finally, since we're ready to close up for the night and go back on vacation, which because of the weather hasn't been that great of a vacation, but we're dealing with it. Here we go. FOMC consensus opinion is that the economy will probably improve gradually. Inflation will rise only moderately and slowly over time, warranting a very gradual approach to tightening. And that's what we were trying to get at before. Do not expect the Fed to come in a quarter, or even a quarter and eighth. Ms. Yellen has said that they're not on a preset or, as she put it, mechanical course for rate hikes. So don't expect a quarter pause. It could be a quarter, wait, an eighth, wait, 3 meetings, quarter. It's not. We're not looking at these very high rates, but that's because we're not looking at very strong growth. And what was interesting, there were no dissents on policy. Not even probably the most hawkish. Regional Fed president left, and he has a vote. Richmond Fed President Jeff Lacker, even he voted for this policy course. So that's telling us something. When the most hawkish guy on the Fed says, "Okay, we'll wait and we'll give this very dovish language," I think even Mr. Lacker is realizing that there's not a whole lot of upward pressure on inflation here, and there's no reason to tighten quickly. That doesn't mean you shouldn't tighten, because I think, and Bond Squad thinks, that rates are too low and we should have tightened over a year ago, at least the token move, just to get off zero. Just think we would have room to cut if we did that, if and when Greece blows up, which is looking like a more likely occurrence. Fed chair warned that economic conditions might be low rates in over a long time. Fed sees labor slack lessening, but could take longer. Does that mean years? Before labor conditions are truly tight. And that's it. I mean, it was a very tame, innocuous Fed report. Unlike the equity geeks who've been calling for, the economy's fine, it's blowing out, we need to raise rates. Fed's going to have to move. Even before this, we heard one commentator on television, admittedly an equity guy, saying the bond market's finally realizing, this is before the Fed announcement, that the economy is doing fine and rates are going to have to rise. And nothing happens. The economy is just doing okay. It's not doing fine. Inflation is, we're not negative. We don't have to worry about disinflation right now, but it's not roaring. In other words, this might be the plateau of the cycle, right? You might be there already. Fed, you listen to the Fed language and Ms. Yellen's comments. She's telling you that we might be there. It doesn't mean we're going down to a correction, but we might be there. To the end of 2017, we might not be yet to 3% on Fed funds. We don't think we even get to 2 7/8. Bill Gross thinks the Fed stops at 2, and we think he might be right. He might be talking his book, but he might be right. We think they stop at 2.5, and 2 is the neutral, and the half a point's the typical Fed overshoot. But we're in Mr. Gross's camp, but we're not that unique in that the bond guys see it this way. The equity guys who don't know the markets as well as the interest rate market as well as the bond guys do, they think it goes faster. Why? Because it has in the past, and that's going to get blown up. Those with the historical models. History is a good mirror to hold up, or a good example to hold up to see what might happen, but don't rely on it. I'm a historian. I know, it never repeats. It often rhymes, but rhymes aren't the same. Even homonyms. But that's what we have here. Our base case scenario is that the Fed tightens in September. Probably, we said that already. Moving up. Pay close attention to the 30-year government bond. This is very important. When the Fed released its statement and Ms. Yellen spoke, we saw the 10-year yield, which had jumped intraday to about 238, come right back down to about 230, 231. But the 30-year, which was at 309, 310, stayed there. Okay? Now, remember, the longer the bond, the more sensitive it is to inflation pressures. That might be, and we don't know for sure yet, it's just a small sampling of activity on very thin volume, by the way. But that might be the bond vigilantes saying, you know what, guys? We don't trust your vigilance on inflation. We're going to keep the 30-year higher, not the 10, which is in high demand for a lot of reasons, including the repo market. But the long bonds is where we can express our displeasure on you not being, in our opinion, the bond market, vigilant on inflation. So when we said that the bond market would take a dovish sentiment by keeping long-term rates or high or pushing them higher. That's exactly what they did, but they focused on the 30-year, not the 10. So watch that 30-year. We wouldn't buy a 30-year bond, if our life depended on it, unless a client told us, I want to own 30 years, then we do it. But given our discretion, we wouldn't buy it. Too much. You get double the duration of the 10-year, and you're not getting double the yield, right? Why do it? So, and that's where the vigilantes, we think, is where the vigilantes will express their displeasure with a dovish Fed. That's all we have tonight. We're sorry for the technical difficulties, both before and during the broadcast. It happens sometimes. Not an excuse, but we apologize. That's all we have. Time to get back to vacation. If you have any questions, even though we're on vacation, email us. You can call our office, 570-424-1555, and we'll get back to you. But it's easier to email us. Email me at thomas.byrne, that's BYRNE, at WS&M, that's Whiskey Sierra, the word and, AmazonMike.com. Again, we apologize. We wish we went smoother tonight, but in all honesty, there wasn't much for us to say about the Fed and its decision. I'm even looking at some other notes and comments here. Nothing was really surprising to us. Inflation's not a problem. Growth is just okay. We have job growth because right now workers are cheaper than equipment. It is what it is. We're going back to try to do some fishing. We wanted to do that tonight before the broadcast, but the weather wasn't cooperating. Probably will cooperate tomorrow, but we'll see everybody again next week. Again, email us, call us. Don't believe the hype. Tomorrow we have a feeling to be all kind of conspiracy theories out there, all kind of wild interest rate calls. Remember, take it from where it comes. All right, if you're getting an interest rate call from someone who's not a fixed income professional, who's a general investment strategist, question it. They don't know. We don't know where it's going to be, and we have a better handle than they do, and so do most fixed income pros. And with that, we'll say good night here. Let everybody get back to watching ball games, barbecuing, or just preparing for tomorrow's probably interesting day. And that's it. See you next week. Goodbye.